Very excited to welcome back Deso, who spends his time researching the dark corners of the market where people don't always have time to look. He brought some charts for us, some insights, which are going to help us navigate these markets. Welcome back, Deso.
Glad to be back, as always.
Absolutely. So based on your research, I know you've been doing a lot of it, sharing it on Twitter. What is the biggest story that you think people need to pay attention to right now?
Well, that's without a doubt ruble gold. The ruble being backed by gold, or well, eventually being backed by gold. We aren't there yet. And that's one of the reasons why I wanted to talk about it today. I've already talked about it on Twitter at the Deso Games. You can find those threads if you can, navigate the spam, because there's a lot of stuff going on these days. But basically, what I said is where we are at now with the gold-backed ruble is the central bank of Russia has put a ceiling on the price of the ruble. So the whole idea of this is that Europeans must buy gas in rubles, thus they must buy rubles. As they buy rubles and then buy gas for rubles, the rubles basically get drained out of the general economy, because they all go to Gazprom, and Gazprom is 51% owned by the state. So effectively, they're cycling rubles to the Russian state. Now, the Russian state can spend that on war, sure, but Russia can spend a lot more on war than it's currently doing. So they can also hold on to them. And if they hold on to the rubles, it drains them out of circulation. And with less rubles on the market, but the same amount of USD, or in this case, even more euros, because euros are being sold to buy rubles, the ruble will appreciate versus the euro and also versus the dollar, if the same applies to dollar transactions, which it does. So in that case, when the ruble is appreciating, at some point, it's going to hit that ceiling of 5,000 rubles per gram, because rubles are being drained out of the economy, thus it is appreciating. Once it hits that level, the Russian central bank can literally buy gold for free. They can print rubles, give it to the banks for gold. Where the banks get the gold doesn't matter. They will also get it on the open market. And gold will start flowing into the coffers of the Russian central bank, which might as well be the Russian state at this point. Where is that gold going to come from? Well, the Russian miners produce some gold, but eventually they're going to run out of gold as well. So if the gold price is high in Russia but low in the West because we keep suppressing it with paper, there is an arbitrage opportunity. And hopefully every single person watching this channel knows that the entirety of human trade basically runs in fucking arbitrage. So gold from the West is going to start flowing to the East, which means that the gold price in dollars, at the same amount of dollars but less gold, is going to go up. The COMEX can't handle that. The shorts can't handle that. That might break the entire COMEX scheme. And when it does, the dollar will just collapse versus gold. We've known that this was going to happen, the revaluing of gold. Only now, not only are the Russians collapsing the scheme, they're doing it in such a way that is going to cause whatever gold that is left to flow to the Russians via arbitrage. And as long as the gas from Russia is needed, which it is, rubles will be bought on the open market, which drives up the price of the ruble. And as long as that price of the ruble is above that ceiling of 5,000 per gram, Russia can buy gold for free, literally for free. And at the end of the day, that's the absolute genius of it. At the end of the day, how do the trades end? Who ends up with what? That is what's really important here. Well, the Russians end up with gold because they can just buy it on the open market for free. The rubles stay within the Russian economy because they're being bought specifically to buy gas with. So within the Russian state, that is still within the Russian economy. Even though if the Russian state can keep it up, there's a difference between money stock and liquidity. So as there is more rubles and more gold in the Russian economy, there's effectively more liquidity available for investment, without devaluing the ruble. Because again, as long as it's above that ceiling and they inflate it back to the ceiling, they're getting everything in between for free. That is their arbitrage opportunity. And as they get more rubles, more gold, more rubles, more gold, it's basically, it's holding its value while they're getting more gold. Who do you want to bet on here? The people with like $30 trillion in debt, or the people who are getting gold for free?
It's a really interesting scenario. So what do Western citizens start to invest in at that point? Because, or even
if you haven't bought physical gold by now, you're fucked. I'm serious about that. I'm deadly serious about that. Like, for us, it's different. We're still small-time consumers. If we want to get gold right now, we can. But if Warren Buffett wants to get gold, he has 150 billion worth in cash, and the COMEX only has something like 70 billion worth of gold. He spends half his pile of cash in gold. Where's he going to get the rest of the half of the pile of cash? And also, the price isn't set. While he's buying gold, it's going to go up and up and up and up. So whatever pile of cash he has left is going to buy less and less and less and less gold progressively. He is one billionaire. There's many billionaires. He's not even the richest billionaire.
Right. So every single sign is pointing to the US dollar's losing its reserve status. Every single sign, even its percent of global trade, it just keeps shrinking and shrinking. And then you have these conflicts with the West or the East, China, Russia. And so
we haven't even mentioned the petro yuan yet.
Exactly. That's what I'm saying. And so this is a very interesting environment, obviously. And so like, what else are you looking at? I know you did some research into another kind of headwind to US inflation, bunker fuel. You want to talk about that?
I don't want to talk about it, but we're going to anyway, because it's yet another disaster that's going to hit us. So what is bunker fuel? I'm sure that a lot of viewers will hear this for the first time. Well, bunker fuel is ship fuel, to put it simply. When you refine a barrel of crude, you get a bunch of products out of it. The top of the food chain, petroleum, gas, because it burns pretty cleanly, considering what else the rest burns at. And that's why it's used in cars, industry, everywhere. It doesn't kill us when it burns near us, mostly. Now, next up is diesel. Has more sulfur in it, but you can remove that sulfur, etc. And of course, as you go down, you get more and more dirty products with more and more impurities in them, but also still a lot of power because they have longer and longer hydrocarbon chains. At some point, you're going to hit stuff that is basically more or less toxic to burn around humans if they stay in one place, and is so goopy because, gas is pretty liquid, but the more and more you refine crude, the more goopy it gets, all the way to bitumen, which is asphalt, which, you can't push that through an internal combustion engine. But bunker fuel is so close to that some of this stuff has to be heated before it can be used in the engine, because otherwise the pumps just cannot move through the pipes. And we're talking ship engines, so they're huge pipes. Now, the reason why we still use this stuff, even though it kills hundreds of thousands of people a year, and that is not an exaggeration, is because it is dirt cheap. It is literally bottom of the barrel stuff. Very literally bottom of the barrel stuff, because the stuff that's below it is asphalt. It's like almost solid. Now, since the entirety of ship freight runs on this stuff, its price should be pretty important. And we all are aware of the ship freight problems that have happened over the past 2 years. But if you'll pull up a chart of the site that I sent you, you'll see that pretty much all price increase problems up until this point had nothing to do with fuel costs. Nothing at all. The entirety of 2022 and the most of 2021 was when bunker fuel costs were pretty much linear with what it was before the pandemic. Now, I wish I had longer term charts, but I looked for it. Apparently, bunker fuel hasn't been charted that long on the internet. We should be grateful we have these independent resources these days. There's a lot less 10 years ago, I can tell you that much. But from the chart, it should be clear that we have a problem. The price is absolutely blown up following the oil price. You can even put WTI on the same chart on the same site, and you can see that even the spread between bunker fuel and WTI has increased. Now, what that tells me, because I do know supply chains, I think I've proven that by this point, is that eventually ship freight costs are going to go up. Now, they might also go down at the same time because congestion and all the problems that have so far been causing the ship freight price to continue to be high, they might get resolved at some point. But while they're getting resolved, the fuel problem will just increase in severity, especially if oil gets even more scarce than it is now. And OPEC has already said that we have a supply deficit right now. So the outlook is higher. Well, it's going to impact price. So even if shipping costs were expected to come down because problems were going to be resolved, that's not going to happen. They're going to go sideways. Or if those previous problems persist, then this problem is going to compound those other problems, and ship prices are going to go up further, which is going to increase inflation pressures even more than they already did. So that is the real problem here. It's not that some poor ship in some poor country now has to pay double for its fuel costs. It's that the products that are on top of the chip is the stuff we buy, and it's going to go up in price because, you know, a higher fuel cost means less ships can be run. Business got to make money.
Yeah. So obviously policymakers are going to do everything they can, or at least say they will, to bring the price of oil down. These are some things they're talking about. I think the US is already releasing 1 million barrels a day of oil. And is there anything else that can be done in order to mitigate this? Because if not, it's a problem.
I thought OPEC said that the supply deficit was like 2 million barrels a day. So, look, it's not like it won't have any effect, but the effect's going to be fairly similar like the SPR release of last November, or even less pronounced, because last November we had the Omicron scare at the same time as the SPR release. So people expected demand to be crushed. Now we know Omicron is basically the end of the pandemic, and whatever's going to come next is just going to be more virulent but less deadly. And we have no chance of stopping that. So the pandemic is over. We're just going to have to live with it. And nobody expects demand to crater because of the pandemic anymore. Now, we should also talk that demand will actually crater. Now that I remember it, because in February, durable good orders in the US dropped by something like 2%, and inventories built up. At the same time, the Manheim used car index has seen a drop too, while interest rates have risen. And we'll get into credit after this as well. So I think the US recession might very well already be here. And we will see a demand crush from high inflation causing a recession. Thing is, though, that is not going to crush the prices. It's just going to make them rise less fast. And the inflation because of high energy is just going to continue. The inflation because of the war and the lack of resources and the sanctions is just going to continue. A long time back, I actually said on Twitter that I was starting to expect that sanctions were going to become our modern day Smoot-Hawley tariffs. So for the people who don't know what those were, in the 1930s, in the Great Depression, I think in 1930 actually, after the economy had already collapsed, in a sense of protectionism, the US pushed a law through called the Smoot-Hawley tariff law, which imposed very high tariffs on imports from other countries and is widely credited with making the Depression much worse than it could have been, because first off, people lost all their money when the banks went bankrupt, and then they had to pay more for products because, you know, tariffs. Now we have sanctions, which effectively are producing the same result, because either we can't buy stuff, so whatever's left gets more expensive, or we can still buy it, but we have to go through another channel, like buy Russian stuff through China, and China's just going to commandeer a middleman profit, which is the same as like a 20 or 30% tariff. So there is going to be a demand destruction in oil, but it's not going to drop the price like people expect it would. It's not going to go back to 60 or 50 or 70 or even 90, I don't think. Triple digit oil is here to stay for a while, because whatever demand destruction the recessions are going to bring, it's not going to compare at all to the amount of money that the governments are going to print. That's going to devalue the currency itself, which is going to raise prices. And that is not a problem if wages keep up, but so far wages haven't kept up. Inflation in the US is what, 7-8% now? I forgot what the last number was. It was
it's high.
Just think whatever is high and just double it. No, but wages, I do remember they increased on average something like 5.6%. We know wages are not increasing with inflation, and there's only one situation in which that happens: hyperinflation. And people still haven't gotten it because they're thinking stagflation. No growth plus inflation means stagflation. But I have seen zero arguments explaining to me why growth is not going to go negative. Why aren't we going to get a contraction? Like, stagflation means very little growth, zero or a little bit of growth. Basically, what we had in Europe between 2008 and 2020. We had almost no inflation, but we also had very little growth. The prices went up, but the economy hasn't really expanded. We just went from one crisis to another, and multiple packages, rescue packages, whatever. The economy isn't healthy. Otherwise, it could do without QE now. It hasn't really grown. All the numbers just went up in unison. That is stagflation. What we're getting now is contraction because of inflation. And that is hyperinflation. That's like textbook hyperinflation. Only now textbook hyperinflation is 50% CPI per month. Are you fucking kidding me? Are you fucking kidding me? Let's talk about it. Like we were talking about before we went live about us doing a show, but shit talking people and didn't want to do it. Let's talk not specific people, but people in general, economists. So economists now say that hyperinflation, the lower bound of it is 50% a month. Let's talk that through. $10 the first month, $15 the next one, 22.5 the next one. You take half of that. So that's 11, that's 33.75, something like that. You're already up to $50 within 4 or 5 months. So you go from 10 to 50 in 4 to 5 months. And that is the lower bound of hyper. Fuck you. People are going to run for the hills long before that. You know what we have in Germany? The inflation just blew out to like 10%, right? That's a month-over-month increase of 2.5%. And hyperinflation is supposed to start at 50 a month.
Right.
No, we are already in hyperinflation. We have been in hyperinflation ever since I said we've been in hyperinflation, which is the repo crisis in 2020. Ever since it became impossible to turn QE off, we've had hyperinflation. And yes, I know they've turned it off right now, but they've also printed a shit ton of money already, and it does buy you a little bit of time. But it's not going to last, because as people have not noticed, apparently, is that yes, the yield curve is inverted right now, but we were looking at a yield curve inversion around 1.4%, because the 10-year and the 5-year and the 3-year were all around that point. The 5 to 10-year already, like, we're bumping up to inversion around there, and within a quarter, we've gone from 1.4% to 2.4%. There's on Twitter, Wall Street Silver posted a overview of like what the yield curve has done since like 2019, and you see it glitching all over the chart. Well, the last 3 months, it's literally done this. And no one seems to notice. No one seems to care.
No, no one notices, but there are just so many indicators of this. So you have geopolitical pressure on the reserve status of the dollar from China and Russia. Then you have sticky inflation that's not going to go anywhere. All the days of like getting cheap imports from China with cheap shipping rates are gone. So you're not going to get like cheap clothes anymore, right? Because shipping fuel is going up. Big problem. And so I guess the next interesting area you brought is what's happening in the credit market, which is all important, right? Inflation,
Yes.
I mean, rates can't be below this inflation for long without bonds collapsing. So what are you seeing there?
So the reason why I'm harping so much on the yield curve is because when you get down to it, every single loan is balanced or anchored against government bonds. Just think of a 30-year mortgage. If the government 30-year treasury drops in yield, mortgage gets cheaper. If it blows out in yield, like it's done over the last quarter, mortgage gets a lot more expensive. And we've seen that in the US. Mortgages now are just expensive as in 2018. So that applies to 5-year fixed rate mortgages as well, simply because banks make their money off basically lending into the market at a lower rate than they're charging you and making money off the spread. Very basically, that's why banks in Europe have been complaining for years now that government bonds have been below zero, because it costs them money. Normally, they make money on the interest rates on the spread, but if the spread's negative, they have to pay. So that hasn't really, generated the inflation that they wanted until it started doing so. But the problem is that if rates are going up, that means that yields across all the markets are going up. Even the yields you wouldn't normally think of going up, like CMBS. Now, like I said, 30-year fixed mortgage, 30-year treasury goes up, mortgage goes up. Same applies to a 30-year lease on a commercial building, or a 2-year lease, 1-year lease. It doesn't really matter, because you go look at the yield curve, it's all exploded. And the short end is moving up. It's not the long end that's going to go down. So if you pull up a chart of an ETF called ticker CMBS, yeah, you can't make it up. You have seen on the monthly chart, the maximum chart, that it has dropped from something like from basically the all-time high to the all-time low in 1 year and 3 months. And 90% of that move has been done in the last 7 months. Now, I will challenge anyone out there to find me a chart that has dropped from its all-time high to its all-time low in 7 months, in the last 7 months. There's plenty of stuff that's gone up, and bonds have suffered a bit. But you go look at LQD or HYG, they're nowhere near as bad as CMBS. Just go look at the share price of WeWork, for instance, how that has fared over the last few months. Now, obviously, that's a case apart, and it was always going to die, and we can't wait until it does. But the general consensus is there that CMBS bonds are just dropping in value very, very quickly. Not just that, they've dropped in value so hard, so quickly, that they have bashed through every single resistance all the way until the all-time low. It did not hit a single bit of resistance on the monthly chart from the all-time high to the all-time low. Because when it started dropping, it was still above any previous price before the pandemic. And it's just, it's hard for me to explain how brutal that is. Now, just so people understand, ETFs have an exposure to the underlying price, whatever the underlying price is. So PSLV has silver underlying, so it moves with the silver price. HYG and LQD, they have investment grade bonds and junk bonds underlying. So if the price of LQD goes down, then investment grade bonds go down. I think it was. I always get the two confused. But it goes for any ETF. So if the CMBS ETF, no matter that it's got a smaller assets under management than all the other ETFs, although, something like 225 million, still nothing to sneeze at. even though it's smaller and means liquidity is less, it is a good reflection of what is happening to the prices of bonds in the corporate mortgage-backed security market. And honestly, that has to give problems at some point. So what I'm expecting, and we talked about this before going live, is that even if QE doesn't get booted up, the secondary and primary market facilities of the Fed probably might. You know, back in 2020 when they started buying Apple bonds and everyone was complaining that I know these companies, like these are all big companies, why do they need extra money? Well, that's because all the focus was on those companies. Everybody thought the markets were doomed because of the pandemic. So the focus was on the big names like the FANGs and the Berkshire Hathaways and the Apples. And as long as they went up, people had confidence that we weren't all going to die. And that's why the Fed bought those bonds and not the companies that were actually suffering. But pretty soon, they're going to have to buy the companies that are actually suffering, the zombie companies, because as we know, like 20% of the US market is now zombified, meaning that there's companies that can no longer service their debt with the income from their earnings. They have to borrow more, meaning that the moment they can't borrow anymore, they just crater, they crash, they go bankrupt. I've seen so many companies with a negative book value per share, where you can sell the entire company and you still lose money on your share. Those companies cannot handle higher interest rates. And the yield curve is going up. They're all fucked. All of them.
Right, exactly. So why, can you explain why interest rates are going up on these CMBS assets? I know they have to kind of somehow catch up to inflation, but why are these crashing and why are interest rates spiking in this scenario?
Well, again, it all goes back to government bonds. The CMBS leases are basically just loans. Like it's just another type of mortgage when you come down to it. So when it's a loan, it has an interest rate attached to it, and if it has an interest rate attached to it, it's either based on LIBOR or SOFR or in some way repo, just on the government curve. In some way, shape, or form. It all comes back to the government bonds. And the government is printing like crazy. Now, the government can't print money, but they can print bonds. They just need to borrow more in the open market. And as long as the Fed is buying those bonds, the bonds are hidden on the Fed's balance sheet. So it's basically hidden inflation. Now, the Fed has been stupid enough to actually talk about quantitative tightening, selling the bonds of their balance sheet back into the open market. Ever since they mentioned it, go look at the chart. The 3rd of January or something did that. Ever since then, bonds have been sliding and the entire yield curve has been going south. Why do you think it happened at the start of the quarter until the end of the quarter? Because at the start of the quarter, the Fed said, you know what, we might run off the balance sheet faster than before. You what, mate? They're going to add more bonds to a market that's oversupplied on bonds. Why is it oversupplied on bonds? Because the US government is running a huge deficit. They're trying to pass another spending bill. The deficit on the new budget is what, like 1.4 trillion? That's all going to be borrowed. I mean, and yes, it's technically deflationary because you're extracting currency from the market, but that currency is then getting spent on social programs, which is just going to put it right back into the market. So you take currency from the market, you put currency back into the market, but what has been added to the market? Well, more bonds. So currency goes back and forth, and the bonds keep rising and rising and rising, and that's the national debt you see increasing. So while the DXY, so the value of the dollar relative to other fiat currencies, might go up somewhat because there's less dollars in circulation and we might even get a liquidity panic, it's the stack of bonds that keeps going higher, which is the real problem. And because we live in a fractional reserve currency system where the value of the currency is determined by the value of the bonds, if the value of the bonds starts sliding, the value of the currency is sliding.
Right.
So that's the real problem. The US government needs to stop spending so it stops selling bonds in the market so that the amount of bonds out there stays the same.
Exactly.
Look, just because we're not under a gold-backed currency doesn't mean the currency itself is fiat. It's a common misconception. What fiat is when a government prints its own money, gives it out, it's backed by nothing, and they simply say, let it be so. That is basically a literal translation of fiat. What we have now is the government can't print its own money. The central bank can't print money. But the central bank can't spend money. It can only loan it out. So the government lends the new money from the central bank. That's how new money is created. It can also be created by the banks levering up credit, but eventually that money has also got to go back to the banks creating that credit. So, bank has $100 of principal, levers up 10 times, loans out 1,000, gets 1,100 back at 10% interest, levers it back down, and the extra $100, that is bank profits. That's how banks make their money. Where's the extra $100 coming from, bro? Well, eventually it's going to come from the central bank because it has to print it. The interest is new money. It has to come from somewhere. But since it has to be extracted from the market, either another bank has to print it, but that other bank, once it prints it, makes it out in a loan, which also has interest, which the first bank has to print. So eventually, the central bank has got to make up the difference because you're going to end up in a liquidity crisis.
Exactly.
And that's how we've been going back and forth since 2000 or since 1987, to be more specifically. You can go even back further. God, even to the point where the government was already spending too much, where the US had to drop the gold standard because, you have gold, you have dollars, you print dollars. There's a discrepancy. People start asking for the gold. And unless you drop this back down, well, this is going to drop further and further and further. And at some point, it reaches 8% of fractional reserve. And that's when the US left the gold standard. Right. Because when they went on to the fractional reserve system, the implicit backing was 40% gold to the monetary base. And that reserve ratio dropped over the years. The most notable drop during the 30s when they just revalued gold. Had they not done that, the US had to drop the gold standard much sooner than in the 30s. But, at the 70s, at 8%, and France sending over battleships to get their gold, just in case everyone else does the same, well, the US just had to drop the gold standard because they printed too much currency and didn't collect enough gold. And now we can actually tie this back just for fun, way back into this, how we started this. The Russians are basically re-implementing this system. Because, just as the US dollar was printing too much and gold dropped because of it, because of that ceiling on the ruble, now the ruble is going to increase, and that's going to increase the gold, but that's going to increase the ruble supply, but it's going to devalue again because of gold, it's going to increase in value again because of gas, selling gas for rubles, and rubles being destroyed. So it's basically rubles, gold, rubles, gold, rubles, gold, rubles, gold. As opposed to the fractional reserve system of more dollars, less gold, more dollars, less gold, more dollars, less gold, gone with the gold standard. That's the difference between a commodity-based economy and a debt-based economy. We are in a debt-based commodity, and Russia is very rapidly moving to a commodity-based economy. If we don't keep pace, we're fucked. And you'll find that we're already fucked.
Right. So you have, interest rates are the oxygen of the economy. They're spiking. Bonds are crashing. The Federal Reserve has worked very hard for the last 20 years to try to keep interest rates down. Well, now they're losing control of it. They're going to have to stimulate even more to buy more bonds.
And that's going to make things worse.
Exactly.
Because there are already too much bonds. Exactly. And that's what I've been saying for quite a while. You can't solve too much debt with more debt. Right. And if the currency is based on debt, if you print more currency, you are printing more debt. You're trying to solve more debt with more debt.
Yeah. And so it's an inflationary vicious cycle. And so my question is, if you look at other big empires that have tried this, British Empire, they went through World War I, World War II, had to print money. And so they I guess what does it look like in America when that happens?
The best analogy, and I came across this, that's in one of the threads that I posted on Twitter, is what's happening now with ruble gold is This is the Americans' Suez Canal crisis, the Suez crisis, where Egypt and England invaded the Suez Canal to keep it under their control versus, I think, Israel and France. And the US used financial warfare to basically cause England to retreat and acquiesce. And that was the moment in which the world knew that the pound was no longer the global reserve currency, but the US was with the dollar, because the US had used its dollar might to basically force England to heel.
Wow.
And what's happening now is what Russia is doing is using its commodity might and its low national debt to basically force America to heel.
Right, Russia and China. And so you could argue that they're doing this, and they are clearly. There could be a moment, a tipping point like that. But like, what does it mean if you're an investor in the British Empire at that time? Can you still buy the stock market? You know, is the United States going to be a
England after the Suez crisis? You can read about it on Wikipedia, but after the Suez crisis, England went into an economic crisis and downward spiral that led into the situation in which it is today.
Which is what?
Minor power within Europe.
So it loses control.
In fact, you could say that currently they're a vassal state of the US after Brexit. I agreed with Brexit at the time. I think we should all be able to chart our own destiny, if you will. But the Tories completely fucked it up. Instead of having that independent destiny, they basically just left Europe to sell themselves to America. And now they're following US Anglo-American policy, only it's more American this time than Anglo. And that's what they gave up.
And so it's an interesting dynamic. So let's say that happens, you know, the United States loses its empire status. Can you still buy real estate? Can you still buy stocks? Because you could in the British Empire.
Sure, you can buy stocks and real estate. Look, the market's not going to disappear. Trade is just humans trying to survive better. So we still need houses to live in. We still need food and water. It's just that when the US dollar stops being the global reserve currency because everybody's starting to switch trade to other currencies, and that doesn't even have to mean the demise of the euro could even benefit from this because Russia is not seeking a unipolar world. They are constantly saying multipolar. So the ruble would be part of a basket of global reserve currencies, if you will. But if you ask yourself, what is the central anchor for value in this situation? It wouldn't be the dollar. It would be gold because it's always been. So in that case, again, the US will just have to back its currency with gold. And if they still have the 8,000 tons that they say they do, which there are many doubts on whether they do or not, you're just going to end up with a dollar price per ounce of 85,000. If you divide USM2, which is the money supply, by the 8,000 tons of gold the US has, you come out to 2,700 and change per gram. And ounces are 31.103 grams. So times that, you come out to approximately 85,000 dollars per ounce. There's no way around it. It's fucking math.
Yeah,
it's just math. The problem is, you can say, well, what's going to happen to the Russians if they do it? Well, like I said before, if they have the amount of central bank gold that they have, which is like 2,500 tons, they're going to end up with 55% devalued currency. But if your currency drops 40 times and theirs drops 2.5 times, you're the one that's fucked. Like being rich is relative. If I have $100 and you have 10, I am 10 times as rich as you. And if it's just you and me in the economy and bread is a cent, I am very rich. So the same is going to happen on the global stage. And again, that's what I wanted to say. Russia might have more gold than they're leading on to. So Alasdair MacLeod has sources that have told him that the real number that Russia in gold has is approximately 12,000 tons. So they would have 4,000 tons more than the Americans. And you know what's really scary? If you divide the Russian M2 by 12,000 tons of gold, you know how many rubles per gram you get? 5,555.
Wow.
And before I knew that, I predicted that the current ceiling in rubles per gram would be followed at a later date once this arbitrage scheme has run its course, by a floor on rubles per gram. And instead of a hard peg, just it's 5,000 per gram, period. Instead of that, we will have a soft peg. So the central bank will buy gold for rubles at 5,000 per gram, but they will sell gold for rubles at 5,500 per gram. And the range in between is where you basically have a floating currency where they can absorb shocks. Because just think about this. If you accumulate rubles before all this happens, and they just peg it at 5,000 per gram, and then you start selling rubles like crazy, you can basically drain Russia's gold like nothing. But if you have an upper bound and a lower bound, the moment somebody tries to dump rubles in order to get Russia's gold or to drain it, Russia can basically say, you know what, today we're going to peg it at 6,000 rubles per gram, or 7,000 rubles per gram, or 8,000 rubles per gram, or 9,000 rubles per gram. The US can't do anything against this. And at the same time, this is going to have a psychological effect of everyone not selling their rubles. It's the same as the Federal Reserve jawboning the markets that they're going to do this much interest rates or this many percentage points. The Russian central bank is basically upfront saying, look, if you're trying to crash the price of the ruble and drain all our gold, we're simply going to change the lower bound of the peg, and there's nothing you can do about it. You're just hurting the amount of rubles you have left because you can't sell your entire pile. You have to sell it on a continuous basis. And the moment they revalue the ruble lower, at least they lower that floor, no matter how many rubles you have left, they suddenly buy less gold per ruble. So that's Russia's protection against the US trying currency manipulation with the ruble. They're basically employing their own currency manipulation. Let's be real here. But there's nothing anybody can do about it.
Absolutely. So in this scenario, why wouldn't people rush into Bitcoin? Because the narrative is that it's a safe haven. It's being pushed on everyone, right? Why wouldn't they put their money into Bitcoin to escape fiat?
Because there's about 186 billion worth of stable coins out there, and I don't trust a single cent of any one of them. Tether is 82 billion and printing again. USDC is below 52 billion because they lost 2 billion over the last month and a half. Whenever Tether's printing, USDC doesn't print, but whenever Tether goes sideways, USDC does print. There's still questions about their attestations. Both have never been audited. And between those two, it's already 130 billion worth of Ponzi scheme, most likely. The next one down is Binance USD. Well, I'm not trusting a stablecoin from Binance because I don't trust Binance. Next one down is Terra USD, which is now $16.8 billion. That one, I know it's a Ponzi scheme because you can see what it's backed by. And UST is backed by B Luna, which is wrapped Luna. And Luna already backs the value of UST. So it's double backed by Luna because it's an algorithmic stablecoin. So if the value of UST or the peg drops, they sell Luna to get dollars to rebuy the peg. So in that sense, it already backs the value. But if you go look at what's collateral is also backing UST, because that 16.8 billion isn't just cash, it's also collateral. And part of that collateral is Luna. So Luna's backing it twice. That is a Ponzi scheme. It is not worth its market cap. It's not a stable coin. But there you go. Next one down is DAI. That's 10 billion, and that consists of USDC, UST, and other stable coins. It's a collateral coin. The collateral vanishes, that coin goes down too.
That's interesting. That's why Luna is buying like billions of dollars of Bitcoin as a reserve asset on its.
Go look at the Luna price. It has to go up because if it goes down at the same time that the UST market price goes sideways, the market cap, the whole thing collapses. That's a Ponzi scheme that has reached the exponential stage, and it will just collapse at some point.
All right. Well, I knew we'd get a lot of good stuff out of you based on the research you've been doing. Thank you so much. Where can people go to stay on top of your updates?
If you want to get spammed like crazy, go to Twitter because that's where I hang out. Yeah, I'm sorry, but with long COVID, some days all I can really do is just look at my feed and keep my mind off things by just working, I can bend over for 30 seconds and I have to rest for 5 minutes. So as long as I move sideways horizontally, it's fine. But if I have to bend over or walk the stairs, it's hard. So some days looking at my feet is all I really do, and well, it ends up me spamming people. You can go to Twitch, where I stream at least 2 times a week, twitch.tv/DesoGames. If you got questions you want to ask me directly, I am literally there to answer people's questions 2 times a week at the minimum. So that's where I am. Otherwise, desogames.substack.com, where I publish articles every so often, but I haven't written anything in a while because the only article I can write is "We're all fucked." And I'm too depressed to write it right now, to be honest.
This discussion is for informational purposes only. Please consult a certified financial planner when making any decisions about investing. And do your own research before making any decisions. Investments are risky, and you can lose lots of money in them.